Good morning, everyone. Thanks so much for joining us this morning. We're thrilled to be talking about real estate and the opportunities in the industry right now with many of the titans of the business. And so thank you, all of you, for joining us. We've got Mike Weil, Barry, David, Michael, thank you so much for joining us this morning. We want to kick it off with really looking at where the opportunities are in real estate and characterize the industry. Because we all know that Victor Coleman as well, real estate has created and presented some of the best opportunities in all asset classes in the last 5 years. So we want to see if there are new opportunities or perhaps is the industry looking at something of a peak. Let's talk about that. David Simon, will you kick us off and characterize for us your take on what real estate as it relates to retail, the mall business, looks like today?
Well, generally, I'd say real estate cash flow is growing. You know, the better real estate assets are growing a little bit better than the kind of where the GDP growth is. And given the volatility in the world, to have assets that are hard physical assets that have cash flow stability, you know, is valuable in today's low yield environment. And you know, it's funny because I'll never forget in '09, which, by the way, most of us have been in the real estate business a long time, right? Almost too long? Would we all agree on that?
I would say so.
Okay, so it feels like it. But the real estate recession that happened in '09 was child's play. I think we'd all agree to kind of the early, late 89 through 93, 94. And so going back to the real estate recession, in '09, our assets are relatively stable. They withstand withstand negative narratives. They withstand retailers coming and going. But in '09, I would go out and see non-dedicated real estate investors, and I'd say, what do you think happened to our cash flow in '09? And they would look at me and say, I bet it went down 20, 30, 40%. And I said, well, what if I told you it was flat? And I think that people have now begun to appreciate a lot of changes, but high quality assets tend to retain their cash flow and will grow a little bit better than GDP growth. There's not a lot of new demand in all sectors of real estate, but there's not a lot of new supply, and it's a pretty decent environment given the overall volatility that exists in the world.
Yeah. David, I'm going to jump in on that because I think that's the theme around today where you're getting at is the biggest differentiator before you talk about capital markets and foreign capital and the likes of that is it's really a marketplace where it's the haves and the have-nots. And so whatever market you're in, it's best in class, and I think you know we're all sort of owners of that. It's best in class, best markets, best performers, and they have outperformed in good times and in bad times. And I think that's sort of where, you know, even if you look at the worst of times in the late 2009, 2010, 2011, the best markets still performed much better than anything else, and the quality of the real estate outperformed, and revenue was exactly what David said. It was flat.
But it is, you know, there are things this year that do make things a little different, whether it be because of the global economy, because of what's happening on the global stage and money coming into the U.S., as well as other issues like supply. And let me just reiterate who's up here on stage, because you heard from David Simon of Simon Property Group and Victor Coleman of Hudson Pacific Properties. We've also got Barry Blattman of Brookfield Asset Management with us this morning, and Michael Weil of AR Global. Gentlemen, I hadn't introduced you earlier. So kick us off on that point, Michael. What's different this year in terms of real estate, and what are the metrics you're looking for or at in terms of gauging where we are?
Well, before you talk about the fundamentals, I think that we're at a point right now where how real estate is held is an interesting conversation, because some of us have real estate held in publicly traded companies, some of us have real estate held in private vehicles. And when we look at the public markets coming out at the beginning of this year, we saw REITs trading below net asset value, NAV. And that created some interesting opportunities for those companies with assets that have increased in value. That became a time where issuing equity in the public markets may not be making sense, but recycling assets within the portfolios does make sense because when you're a public real estate company, not only do you focus on the quality of the assets, but of course you're focusing on the earnings per share, because that's what your investors are really looking to you to do. It creates opportunities to do, and in some cases, stock buybacks. But the fundamentals really come down to how good is the real estate and what are the asset classes. David touched on the fact that, we have limited new supply coming online, which if you are feeling like real estate is coming towards the, I would call it later stages of a cycle, I think that with limited supply, it feels very different to what we saw in the last correction, going back to 2006. And
that's when real estate gets hurt most, when there's a lot of supply. If having just been in London, if you want to freak out on supply.
See the cranes.
Cranes. I mean, I have never, it reminded me of a city that I can't pronounce in China. One of these things where you see cranes everywhere.
Which city are you?
London.
Right
and
now.
And even in New York, you have obviously probably a little oversupply of the condo market we were talking about in the break room. But London is like, when's the last time someone's been to London? It is freaky, okay?
How much buildings go?
Yes, I couldn't believe it. So the good news is if we do go into a downturn generally, and I'd say, we are flatlining worldwide, okay? But if we do go down in a downturn, the supply is not going to kill us. We're going to have other issues, but it won't be because we have all this, at least in commercial real estate, we won't have all this excess supply.
London, I guess, makes sense to me because of what's going on elsewhere in the world, whether it's China and a slowdown there or Middle East issues. You're seeing people look for good cities, and that's why New York and London. So I can understand that the oversupply in London, I guess, but you're saying it's pretty
I think it's very aggressive.
Yeah.
If we have a London expert here, they can tell me where I'm wrong, but just a gut feel given the amount of activity going on.
And that's where we all worry, I think, as real estate operators, acquirers, et cetera. But when you see those supply metrics on the verge of significant change, everything, no matter what asset class, comes down to supply and demand. And when supply starts outpacing demand, everyone in this room understands it's going to have an impact, a negative impact on the rents we can charge. And the driver behind real estate and why it is such a consistently popular asset class is because we are a great income alternative, a yield alternative. And when rents start to feel pressured, that can change. So that's where there are probably 5 markets in the world like New York, London, you get it out here in Southern California a little bit, where that foreign money does tend to chase what I would call trophies. Not necessarily the fundamentals that I think any of us would be comfortable with, but if it's a trophy asset that can be put away for 10, 20, 30 years, which many of the sovereigns can do, the foreign investors can do, they feel that that's a safe investment. It's a good place to take currency out of whatever country that may be, put it in a market that's secure, and not worry about it. That's the headline that many people read about, but that's really not what drives our businesses.
And then, of course, another change to reference is interest rates and whether or not we actually are going to see a change in rates going forward. Barry Blattman, characterize the situation for us and your thoughts there as well on rates.
Yeah, so I think rates is part of when you ask the question, what's different about real estate this year? And I think everything that we've been talking about, including the question about rates, it all fits into the fact that there's really nothing different about real estate this year. We're just in the middle of what is a typical cycle, and it's really important to observe the drivers of the cycle. So as it relates to interest rates, we are not seeing interest rates fueling debt in a way that is similar to where we've seen real estate crises arise in the past. We're not seeing, even though leaders of banks yesterday announced that they're going to tighten their commercial real estate lending programs, like we're not seeing real estate getting bought in terms of the premier real estate by thinly capitalized buyers that are using leverage that are coming from specialty lenders that are willing to lend at the full value of the asset and driving irresponsible ownership. When we look at sovereign wealth funds putting a lot of capital into these high quality buildings in fantastic markets, it's mostly equity driven. I was in a panel yesterday where a discussion happened on energy markets and did markets get irresponsible because they lent so much money to energy companies, and should it have been equity instead of debt? The fact is, in real estate, it's been a lot of equity. It hasn't been a lot of debt. So there's real owners, for whatever reason the sovereigns want to be owners of these assets. There's real owners that are buying based on converting, in many cases, like their holdings of long-term treasury bills into the best assets you can own in US markets. We're seeing a return to the urban core, which is driving office prices, it's driving condo development, maybe to a point in some cities that is concerning and making headlines. But the fact is that we're seeing a delay in terms of home formation after the financial crisis. We're seeing strong demand for lots of real estate out of the cities that are creating the concern, but it makes sense that there is the kind of demand for properties in the cities. And then, to David's point on what's happening in the high-end malls, we have a major investment in general growth properties. And what we're seeing is the fact that people that have a lot of money are spending a lot of money, and the cash flows are fantastic. In fact, saying the same point that was made, cash flows are fantastic. We just raised our next flagship global opportunistic real estate fund. It was $9 billion. It's twice the size of our last fund. A lot of it already invested, and so much of it is driven by cash flows, with the assumption that we're going to be selling to the interest rate question at a higher cap rate, because you have to expect that interest rates are going to go up. I think, if I can be a prognosticator on interest rates, which I have no right to do, I mean, the interesting thing to me is when markets do start to hit some turbulence and something has to happen and central banks can't fuel it by lowering rates, hopefully politicians and democracies are going to make decisions that help us move on. But the fact is that real estate is not owned in such a levered way that crises at this point is going to create crises for owners like us. We have capital structures that are going to withstand. That's why we're all survivors, because we use capital structures that withstand crises, and we live to see the next day.
You make a good point about sovereigns, and I want to get back to that point because I really would like to zero in on whether or not the flow of international money is still where it was in terms of Russian money and Middle Eastern money and China money. But before that, what about the question why? I mean, we are almost 10 years away from the financial crisis. You said, we're sort of still bumping along the bottom in terms of the broad economy. You all don't seem to be too nervous about real estate where it is right now, but are in a situation where we're not seeing that much vibrancy. What's holding us back?
Well, that's none of us want to get political, right? Even though my home state is having a big decision today.
Indiana primary.
Indiana, right? So.
Did you vote before you came?
I did an absentee ballot.
Okay, good.
I won't tell you who, but Bobby Knight's one of my favorite human beings in the country, Okay. Because I'm old school and Bobby's old school, and he's
Tough love, David.
he's great. So.
It's regulation.
Indiana's never, other thing is, I go back and forth, but Indiana's never had these negative ads because it's always obviously Republican state, and Republicans usually, anoint somebody, as we all know. So you never see these negative ads. I mean, I think why do people spend all these money putting negative ads on, right? I don't think they impact anybody, right? You would know better than than I do. You think they impact people? I think it's
I
a
don't
waste
know,
of money.
It's sort of, if it's something that holds true,
Yeah. Well, I
then
mean, there's
it
all
might.
elements of
Because
truth
it's sort
in
of a
it.
reminder, oh
Right.
yeah.
Okay, that guy.
But
In any event, so we'll put politics aside.
Yeah.
Look, I think, you know, it's how do I think the biggest issue that we've had is we have a big demographic change. You know, where the baby boomers are aging and the millennials are, you know, just starting to earn a little bit more money, and we can't get wage growth while we're having this big demographic change. And I think we have to just recognize that that's going to take some time to work its way through the system. And I'd say that's obviously the bigger issue, and the biggest issue is we have this big demographic change that's going on that's at least in consumer spending is having I'd say a reasonable impact. And you know, how do we get wage growth? And it goes back to supply and demand, and you know, the whole technology revolution in terms of you know, how companies operate and the fact that they can do more with less, and you know, we're not a manufacturing-based economy anymore, and we've got a real fundamental issue: how do we drive job growth that has wage growth associated with it? Mm-hmm. And that's the biggest issue now. I think as baby boomers retire, assuming they can, millennials, you know, supply and demand for the workforce increases because that group kind of cycles out, then we'll get back to wage growth because you'll have to pay people to do it, and you know, we'll see greater growth. Certainly, the political environment, you know, creates kind of a you know, dark cloud over everything. And you know, whether you're Republican or Democrat or you know, in the middle, you just don't have an environment where CEOs, and I've been CEO basically since you know, 93, 95, essentially. CEOs are not going to be overly aggressive when, even though I have been, but you know, and we can criticize some of that, but CEOs are not going to be wildly aggressive in an environment that's just kind of low growth.
because of taxes.
Well,
Tax
I don't,
reform?
you know, look, I think raising taxes, if we got a thank you note, I'd be okay with it, okay? So, you know, when you give to a charity and somebody says, thank you so much, you feel good about it, you give again. But, you know, when you keep paying increasing taxes and you don't get a thank you note, you know, it pisses people off.
Or you get,
Just send me a
pointing
thank
up the
you note.
finger like you're
Right,
not paying your fair
right.
share.
Send me a thank you note.
I think there's something that we're seeing in the industry, and I feel that the industry has, for now, because we don't always seem to remember long term, but I think the real estate industry is very cognizant of what we went through 08, 09. And when you look at the leverage metrics industry-wide, coming out of 2006, the average asset was leveraged about 55%, some much higher, some much lower, but that was the average. Today, the average is a little bit below 35% leverage. Very healthy for us, because as we come into these potentially uncertain times, you know, if you ask 100 people of their views of interest rates, you know, you will get a very wide answer pool of what and when to expect in the interest rate market. When you talk to the traditional lenders, they will imply that there's a lot of money out there to borrow, but it's a very select asset pool that they will lend against. And their underwriting is very different. They're much more comfortable today saying no than saying yes. There was a great panel yesterday where conversation about the importance of covenants. Covenant-light lending for us is very important. We don't want to be in a situation where one macro change in the economy can have a real ripple effect in our businesses. The idea that every 3 or 5 years, a company can simply refinance their debt structure, their capital structure. I don't know if any of us would be willing to believe that anymore. There are times where that could be true, but we all know that there are times where that's not true. And if you hit that at the wrong point, you destroy significant value, not only in your own company, but for shareholders. So very, very different thought process that I see from the large real estate companies in today's market. I think it's very positive, but it also keeps us out of the headlines. Now your question about foreign money, there was just a very interesting drama that played out with the Starwood transaction, Marriott, Starwood, and Angbang. And it was very interesting. It looked like rationale was going to go to the almost crazy side on pricing. And then at the last minute, it pulled away. And I think that's a good thing. But when we start to see that chase for assets, or the price is secondary to winning, I think that puts up flags for most of us. And you hope not to see it, because that's typically the signal of a bubble.
And those were the signals that we saw back in 2007.
Yeah.
So are we seeing any of the same signals right now, whether it be covenant light, whether it be pricing that seems out of whack to you? Are there signals out there that you're feeling that perhaps could indicate an issue on the horizon?
Not many. Yeah.
I think what you're seeing right now is, and just as Michael sort of indicated, you're seeing a form of discipline, and the discipline, I think, was not in place in the last cycle. It was not in place clearly in 2007 and late 6, 7, and 8. And you're seeing that today based on access to capital, based on the debt markets, based on the ability to capitalize your portfolio. And I think when Barry sort of mentions the interest rate fluctuation, are we concerned about it? Yeah, but not at the end of the day. It's not going to make or break. If you're 30% leverage, it's not going to make or break your cash flow structure. And at the end of the day, you need to be sort of prepared for good times and for bad. And that's the level of discipline that we have to run our portfolios day in and day out. I also believe that, when you're talking about interest rate increases, or the volatility of increasing interest rates, it's an indication of stronger economy. And as a result, that's going to, relate back to higher rents and cash flow for us as landlords and owners of real estate. The interesting thing that you'd sort of mentioned about the signals and what we're seeing around here, there is a shift, and David sort of mentioned around the millennials. There is a shift around millennials, and the demand is to where they want to be. And so if you look at where the populist growth is, it is these main cities, and that is one of the reasons why you're seeing values change in the urbanization of cities like New York and Los Angeles and San Francisco relative to other places in the country where you're not seeing that kind of growth. And when you used to look at Class A assets in all property types in every marketplace, the cap rate spreads were fairly narrow. Now, Class A assets in New York or Los Angeles and San Francisco, the cap rates are much different than the Class A assets are going to be in Chicago or in Houston or Boston or other places around the country.
But it also depends on what sectors you're talking about, right? I mean, if you're exposed to, as you are, technology and the Googles and the Facebooks of the world, or autonomous cars, or healthcare, which is where growth is right now, you're seeing a different story versus like mining.
Well, sure.
And
I mean, listen, I think the shift in technology today with these large companies has created a whole realm of security around it. Now, there seems to be a sentiment, and I think this is sort of where Michael was sort of getting to. What's on the front page of the paper is not necessarily what's happening on the ground level. And so there's a sentiment around if Google comes out or Apple comes out with their worst performing quarter in 5 years, all of a sudden, we're in trouble. The reality is they're not giving back space. There's people are still going to be employed, and as a result, they're growing. This is the future generation of I think, technology going forward.
The only thing I'd say generally, and I think we should, we are complacent. Why are we complacent? Well, number one is our stocks are, near all-time highs, so, that makes us feel like we're really smart. Two is you know, the recession, it depends on your perspective, but the recession for real estate in '07 to, you know, whatever, '08, starting whenever the bear, '08, '09, was relatively mild, and the transition and the restructurings that occurred relatively easily, okay? So if you go back, and it depends on, you know, what your perspective is, having lived through the early 90s, you know, that puts, you know, in the back of your mind, you got to be careful. And in '07, '08, '09, there was one company that was frankly shocking that they had to file bankruptcy, which Barry, you know, beat me out of the deal. He shouldn't have, okay? And if you want a
You beat us on other
if you
ones,
want a
David,
history of that, we have a breakout, okay? But he had one big supporter, which we won't name who he was, but the shareholders actually would have been better with my deal. But it's fine, don't worry, I don't care.
I think you lost your
Okay.
train of thought.
I don't care,
So,
I'm over
what were you saying?
I'm over it.
Are you?
Barely.
I'm over it.
And we are in.
Yeah, no, so in any event, but you know, it wasn't that hard for us, right? I mean, literally, it wasn't like, you know, we were a little nervous, but so I think we are complacent. But you know, it goes back to, you know, I do think we were on the edge of, at least in retail, of getting a lot more supply than we should have, but hopefully lenders understand, you know, it's fascinating to me in real estate, the same lenders make the same mistake every damn time, okay? It's the same group of, you know, and I won't name names, but, you know, they get burned, they end up owning casinos, you know, Barry takes advantage of them again, you know, when he buys this and that.
And then they clamped it.
And then they loan again, you know, like you know, it's like, why haven't they learned? But we're relatively complacent, and, you know, that's a little nervous. You know, maybe we shouldn't be, okay? Maybe we shouldn't be, but, you know, the industry is solid, but these things can change pretty quickly, and, you know, we'll see where it goes.
I don't think that complacency is you know, something that deserves any kind of criticism. You know, I think that we all get the opportunity to get a real sense of what's happening with capital flows. I mean, we in our organization, because we raise so much money from large pools of capital around the world. For example, I was meeting with the CIO of a large state pension plan the other day with his head of real estate. And the head of real estate was talking about the quarterly presentation that was going to be made, and made the comment that the values are high, and they're high because of where sovereign wealth funds are buying, and that's concerning. And, you know, that's a brake that, I mean, a brake pedal, you know, that is good. Marie asked the question, you know, what's holding us back? I think if that question has to do with what's holding back, you know, any kind of more dramatic rise in real estate prices, like, thank God that's the case. We're seeing, I would say, in most things that we look at, a pretty nice steady increase, and life is good when there's a nice steady increase. I think in terms of the questions about what's happening with sovereign wealth funds, you know, the deals that are most notable in the news are where they're coming in and lifting, you know, companies at big profits for people or assets that were just bought. What we're seeing is a lot of sovereign wealth funds that are looking for direction from companies like ourselves and investing alongside us. So, for example, we acquired Potsdamer Platz, which is, you know, at the core in Berlin, a critical property for that market. We bought it in partnership with a sovereign wealth fund, and you know, that was a very appropriate, safe investment for them of a great core asset at a pricing that arose out of some complexity. We acquired, talking about London, the Canary Wharf estate in partnership with the Qataris. You know, they did it alongside us. It was a situation where there was a complicated capital structure that gave us a value opportunity. And then in raising our most recent fund, and real estate is one area that we're in, infrastructure and private equity or others, we're in the process of raising lots of capital. We are seeing the, you know, oil-driven sovereigns pulling back a bit, and we're seeing the Asian investors coming in, I would say, even in bigger size than where the Middle Eastern investors are dropping to. But you know, mostly these are Chinese insurance companies that are seeing, you know, a tremendous growth in premiums in a new industry that didn't exist before. These assets are perfect for insurance liabilities. So, you know, it makes sense, and not really concerning. The last point I want to make is just, if Maria's question was related to why isn't the economy taking off, clearly residential construction is a big driver. We happen to quietly own one of the larger residential companies in the country. I think we're the 6th largest in terms of home building and the 3rd largest in terms of lots owned. And over the last 9 years, the country hasn't come close to the 1.5 million housing starts per year. That basically is what the country needs in terms of to meet the demand. And in 2016, I think housing starts are going to be 1.25 million, so still not even getting to that 1.5. There's probably like a 4-to-1 multiplier effect in terms of what happens with home construction, in terms of what drives the economy. And we need these first-time home buyers to start coming in. It can't be in the urban core because multifamily and condos are too expensive. But technology is changing lots of things. We are the owner of what used to be called the World Financial Center in Lower Manhattan. We renamed it Brookfield Place. It was a bit of a branding exercise, but it also was reflective of the fact that Lower Manhattan is no longer the hub for financial service companies. Condé Nast moved into One World Trade Center. Google, all the other technology companies are coming downtown. It's a lot more exciting and vibrant than when it was a bunch of financial people. And lots of people want to live down there. So, there's lots of opportunity coming out of lots of challenges, a lot of opportunities, but generally the slow, steady, not over-leveraged, it feels pretty good in real estate. It's not complacency. It's just a recognition of cyclicality, and this doesn't feel like the severe risk cyclicality that we've seen in the past.
Victor?
Well, and the low-hanging fruit's done, right? I mean, the ability to buy in the short-term holders versus guys like us, the ability to buy and then sell quickly and sell in 2 and 3 years because you're riding the interest rate volatility or you're riding the cap rate markets or the access to capital. Those guys, those opportunities aren't available anymore.
And I think the institutionalization of real estate. I mean, we all look at the lens of what we've seen, but when real estate had one of its most important crises, a lot of real estate companies evolved their ownership. They were family companies. They turned themselves into public REITs.
Yep.
A number of them didn't have the right kind of plans for when the leadership no longer was wanting to run the company. They institutionalized themselves. They created long-standing companies that were going to be fantastic. We had the financial crisis. We don't really have anything like that now. We have instead consolidated ownership. When we say there's no low-hanging fruit, in fact, if you're in the real estate business and you're providing solutions to tenants, I think that's what we all do. David and GGP does it with retailers. You could make a retailer successful or fail based on whether you make available to them being next to every Apple store that you can provide to them. Office landlords, you're providing critical office space, distribution, logistics-related real estate. You're driving what happens with companies like UPS and Amazon. The more that you are providing a service and you have leverage over your users, the more you're going to be able to identify, where growth is going to be, where opportunity is. Take advantage of that. It's a little easier than it used to be because you can do it based on a really good business model as opposed to development risk or leverage risk. So it's different. I'm sure there'll be another cycle that is going to cause a conference like this to lament over what happened, but
Right.
There's lots of positives.
And you can remember what Barry said, so blame Barry.
One of the things that comes to mind as Barry speaks is real estate plays a very interesting role in many corporations, and the use of real estate as collateral, whether that's in the form of a sale leaseback, which many of us have been involved in, it allows the company to sell its real estate, lease it back long-term, retain a lot of the tax advantages, but then use that capital for core growth. We've seen it from companies like FedEx. We've seen it from restaurants over time. So real estate, and we're starting to see it more and more in Europe, as they're realizing the amount of value that's locked up in their assets on the balance sheet that really can't be levered to the core business until a transaction like that happens. The other thing that Barry mentioned, and I've been in publicly traded and non-traded, and I'm sure there are many things of being publicly traded that are great, access to capital, et cetera. But at times, I think we've all longed for the days when our companies were private, because we could do things that are more traditional to real estate. And when you're publicly traded and when you're reporting on a 90-day cycle, real estate is not a quarterly business. And you could have the greatest transaction in negotiation that occurs on April 2nd and not March 28th, and it could have a significant short-term impact on your business. And as you're publicly traded with analyst coverage, et cetera, you're hero to zero on a pretty regular basis. And it could really come down to a matter of days. So I think we all weigh those decisions of, is this an asset better held in a publicly traded company, or is this something that would do well in a private company? And a lot of interesting corporate discussion as it relates to real estate.
And what's interesting about real estate, when you mention corporate real estate, so, and Victor probably knows this better than what I'm about to say. I know he knows it better than what I'm about to say. So if you look at some of the most successful new companies that exist, Google, Facebook, Apple, Amazon, the importance of real estate to those organizations, Tesla. Who would have thought Tesla would sell their cars in our malls, okay? Who would have thought Apple's going to spend, I'm making a number up, $10 billion on their headquarters, okay? Maybe that's David's number, it's not to be quoted, okay? I have no idea what they're spending. Who would have thought there'd be Apple stores? What about the Google campus, okay? What about Amazon's warehouses and distribution centers throughout the world?
And they're putting up more and more warehouses.
More and more, and so even these technology companies, the leaders of kind of the next generation of companies, all very successful in their own right, can't be successful without a thoughtful and aggressive real estate strategy. And it gets back to what Barry said. I mean, that's the role that a lot of us play, but you wouldn't think about that, right? What does these guys need real estate for, okay? Because they're technology companies. But the reality is, they spend a lot of time on thinking about real estate.
And what their office looks like and how
the
it's
whole
laid
thing.
out.
And it's both from how they use it to interface with the consumer, i.e. Tesla, Apple, potentially Amazon as they open stores, or how they design their headquarters and get everybody to create the environment they want for prosperity.
Which
So
Google did, and it was absolutely beautiful.
And their meditation rooms.
right.
Yeah, but listen, it's under. I mean, David, you're absolutely right. It is underestimated as to the time and money they spend. That is their culture. And when you look back before, and it was not that long ago before the Apples and the Googles and the Facebooks and Amazons were around. When you look back, I mean, the corporate culture of Fortune 500 companies were mahogany office space or some open bay floors and things like that. But there was zero amenities, and these guys created a culture which now has created the ability to attract talent, and that's why they did it. People sort of think about creative office space, and they say, well, what does that really mean? And the definition of creative office space is putting more people in less space, so they can work together and they have the amenities. And the whole key here is talent, and that's what we go back to. I mean, these millennials are talented people, and these companies are looking for these people to work with them and to attract them. It's not just because we make a great widget. They're attracting because of the environment. Just one thing that Michael said. As much as a lot of these companies held their assets on their balance sheets, and for years people were saying, you've locked up capital. If you look at the large guys like the Googles and the Apples and the Facebooks in the technology world, and you look at what they have half leased and half owned. These guys have millions and millions and millions of square footage that they own and they've created. And David's absolutely right. I mean, there's the Apple spaceship that they're building right now. I actually got to tour it 3 weeks ago. It's incredible, and they're spending billions of dollars on an environment and a culture, and they think like a university. They don't think 5 or 10 years, they're thinking 100 years. So the vision as to underestimating these companies, and that goes to the sentiment today around tech. The front page of the paper is because, as Michael said, a quarterly report comes out and they didn't do well. Well, that doesn't mean the value of the company's gone. These guys are here for the long haul. It's a different cycle than we've seen in the past. And the correlation, this is just like 2000, it's not even close to being like 2000. These are long-standing companies. Yes, you're going to have
with
companies
profits.
with profits and some without, but you're going to see bankruptcies and you're going to see
and with
consolidations and revenue. That's the big difference.
Yeah.
But you're going to see that too. But what happens is you're also going to see guys grow in just exponential bases. And now it's not just in California or in New York. They're growing everywhere because they have to. They have to attract a lot of people that they're trying to bring on board. And they're the providers of these jobs and the value going forward. And the correlation of that to real estate and their homes and their environments and their work environments and the likes of that is all now consolidated. And before it wasn't. And that's why I'm a big believer in the urbanization. I do think that is key. And I think that's where you're seeing a lot of demand. And maybe, as David inferred, maybe some overbuilding down the road in those markets versus you're not going to see a lot of people building in some suburban marketplaces and basically get out of control for growth.
But that overbuilding can last a long time.
Listen, when you have vacancy that is long-standing, it takes a long time for markets to come back. It doesn't happen overnight. But I think that's the theme of real estate, and I believe that's what Barry was referring to. Listen, we all look at our values, whether we're public, as David just mentioned, you're mark to market every single day. But the fact is, real estate is not a mark to market business. And so, yes, it can be impactful for a long time, but so is our business. In terms of ownership, we hold for long periods of time. So you ride through these waves.
Yeah, and I think that what we're getting into is a little bit about the difference between long-termism in terms of real estate owning and short-termism in terms of real estate investing. And there's a lot of very positive things to say about long-term capital. Real estate is a long-term asset, and where there's a lot of noise is more the short-term type things that happen. People talk about condo oversupply coming in cities like New York and Miami. I was gathered with a group of real estate people recently, and somebody made the comment that it's not really happening in Miami. Like a lot of the projects that would have given rise to the great levels of concern are being shelved because there's a discipline that is the kind of thing you'd like to see. I think also, we talk about not a lot of debt in a way we've seen in past cycles. I mean, there's a lot of debt, but it's not at the level that gives rise to crisis. The fact is that commercial real estate debt finds its way into the capital markets like any other capital market product. And we're heavily involved in credit at Brookfield in all different forms, real estate and infrastructure and other industrial companies. And there is no liquidity in the credit markets. So when there is meaning that the Wall Street dealers aren't making liquidity, everything that you've heard about, there's no doubt that there's going to be heavy noise in real estate debt when something happens. Rates go up, markets shutter, conduit lenders, the different financial institutions suffer big losses. It feeds immediately into real estate pricing. Like there's going to be volatility. There's going to be great days for groups like ours that take advantage of that volatility. But with staying power, there's that healthy backdrop, and I expect lots of noise in the short-term swings.
And things move quickly. I mean, look, the first quarter of this year, you had, in the public markets, NAV valuations at 25 to 35% below, and private market valuations turned around, and they took advantage of that. And people were like, well, whoa, why is Blackstone or TPG or other guys out there buying these companies? Because they can see. And now look, we're 2 months into it, and it's 30% increases in valuations. And so they were right. So there is a little bit more volatility from the public market, private market valuation standpoint. But as a result, I absolutely agree with Barry. These are long-term holds versus short-term investing.
But that lack of liquidity, I think, is being talked about as a potential real red flag. I mean, if you don't have lack of liquidity, when you need to sell something, you sell what you're going to sell. If we see a major market meltdown in terms of equities, doesn't that impact real estate pretty significantly?
Sure it impacts it, but I think what the key is that David Simon is not going to say if there's a huge opportunity, lack of liquidity. He's been preparing himself for these opportunities, as the rest of us. David's sitting there on capital or access to capital to buy something at the right time. And that's the discipline, I think, that's changed relative to what's happened in the past cycles.
I mean, you could have a financial model where you're going to update what the value is of what you own every day. You could do it every week. You could do it every month. You could do it every 5 years.
Yeah.
I think that, with real estate, it's a luxury if you could do it every year. No doubt if you do it every day, you're going to get nervous a lot of times and,
Reactionary.
try to have longer term money.
Steve Wynn, there's a very interesting case study that has been talked about with Steve Wynn and Wynn Casinos in Las Vegas. Nobody has issued more of their own stock and also bought it back than Steve Wynn has done over a very long period of time, because he took advantage of those markets. So when it was cheaper to issue capital, he would issue capital, he would grow. When valuations changed and there was a significant discount to NAV, he would buy it back. And he used that tool. The public markets, again, it's that, 6 of one, half dozen of another type of concept. There are a lot of great things that real estate companies can do in the public markets, but we have to always remember there is a right time to grow through capital. There's also, right now, you're reading about a number of companies publicly traded that are looking at, the term everybody likes to use is asset recycling, which means let me take some profits out of this market. This might be the time to take some money off the table to firm up or shore up the balance sheet to get ready for what could happen. But it's not a panic. It's just one of the things that we can lose sight of in real estate. Many people think when you buy an asset, you buy it with the intent to hold it forever. And it's I think one of the things that's changed, pre-2007, it was very rare that you would hear about companies selling assets. It was really, you would just keep them almost forever. I don't think we see that as much today, and we saw it in the first quarter, as Victor was commenting. Private equity, it was a great time for private equity to come in and buy assets because the publicly traded companies had pulled back for what turned out to be a short period of time. So that is where management really comes into play.
You just reminded me of another really important point, I think, in terms of just how you successfully invest in real estate. And I go back to talking, I said before, thinly capitalized owners. The fact is, when thinly capitalized owners buy a piece of real estate, they have typically no money left to take advantage of other opportunities. They may have budgeted for TIs and CapEx, but when David or GGP have the opportunity to buy a Sears store at one of their malls and turn it into inline space, the returns on that capital are fantastic. A much bigger, a big part of the additional story of what it means to own a mall. We have acquired multifamily companies. We acquired Associated Estates this past year, and the dollars that we could spend just on putting, washers and dryers or little amenities into the units, the additional return we get on a lot of dollars that we can spend through higher rents is a much bigger part of the story than where we bought it. But having the wherewithal to get that opportunity out of your properties, just more of an operating business, more of a real business.
So is it a better idea then to invest in an area where we know, the U.S., consistent, slow grower, yes, but consistent, or go to somewhere like a Brazil where you're seeing some upheaval, but perhaps valuations are better, or China where you're seeing a real slowdown, but maybe, well, I don't know if China is as red hot as it once was, so.
I'll give you our view. We're conservative investors. So we saw an opportunity in Europe 5 or 6 years ago. We still see an opportunity in Europe. But for us, that opportunity was Western Europe, stable. We felt that European economy was somewhere 5 to 7 years behind what the U.S. economy had gone through. So coming out of the financial crisis, we saw great opportunity in the U.S. to buy, to really take advantage of that dislocation. When we look at Europe, we then saw that same opportunity. We acquired about $2 billion of assets there. There are different types of owners across the real estate spectrum. And I believe we have to recognize what we're good at. We are not a distressed buyer. We are not a repositioner of assets. We like stable, predictable income. We like to understand our tenant base. We haven't spoken a lot about, and it's kind of interesting with David up here, but we haven't really spoken a lot about the strength of retail. But retail is...
I'd prefer not to, actually.
Yeah, right. Why talk about it? But it's probably the biggest real estate asset class out there.
Yeah,
is retail.
And you've got to be looking at foot traffic in that regard. So, you know, Barry, David, what about that right now in terms of retail? I mean, if you're looking at an economy that's sort of bumping along the bottom and you're not really seeing much growth or little growth, is that impacting retail? And then does that translate into weaker real estate?
Well, look, I think, you know, it's interesting. Traffic generally has been relatively flat. And, but the consumer, last year, a lot was going on, but they did shift toward more durable goods spend.
And cars and
cars
homes.
and homes increased, and you know, that's why I hope never give edicts, because you know, in 9, 10, 11, how many economists said there'd never be automobile sales that would ever go above 10, 11 million a year?
Yeah, I think
right?
a lot of people miss the
Okay,
recovery.
so you know, last year was 18 or whatever the number was. So when that tends to happen, the stuff that our retailers sell in the mall business tends to moderate, because you know that it's typical. Consumer will do a new house, or they'll you know redo the kitchen, and they're you know the simple thing is, okay, let's not do a lot of spending. So we did see that shift going on, and you know, we haven't seen that, if you think about it, for you know a good decade, right? Because even with the downturn in 09, you know, retail, the stuff that we have in our centers kind of bounced back pretty decently, because, you know, as people realized the economy was not going to, you know, just completely disintegrate and start working its way back, people began to spend. So we have seen this shift. And I think that's a cycle that happens, and it's not the end of the world, but we just have to weather through it. And I attribute a lot of that. And in particular, in our case, we also saw the strong dollar really impact tourism spend. And I think a lot of the hotels saw it. You know, we have some great properties that are very, you know, frequented by the international tourism. Strong dollar, we saw a little bit decrease in sales there. So that cycle ebbs and flows. And generally in the U.S., you know, we are over-retailed. I mean, you know, we're over just about everything, but we're certainly over-retailed compared to, say, Europe and other you know, global economies. And you know, we're going to cycle through some of that. It used to take a long time. The half-life of a mediocre mall was long. Today it's a lot shorter, and you know, but that happens, and ultimately it's like anything else, that better assets will get stronger. I don't mind certain supply kind of getting flushed through the system, and you know, but people will continue. You know, I strongly believe, and you know, I'm not talking my book here, but you know, people still want to go out, and we have to do a lot to motivate them to go out to the centers. But you know, we'll do it if we deliver the right kind of product.
Do you want to buy Brazil right now?
No. Not that we've looked at Brazil forever. Barry's in Brazil. He can tell you about it. I think one of the greatest things that real estate guys do is they like positive leverage, okay? See, so, which is essentially that if you're going to finance it, what's the cost of your debt versus the cap rate that you're paying the real estate for it? It's never, it never hurts to look at that metric, okay? And Brazil, given the, has always had, with the inflation problem, always had very costly debt. You have to put basically all equity in to make the numbers work. In retail, there was a huge amount of supply that was brought on quickly. And right now, and we like contrarian plays, but I still think Brazil's a little bit early because, the next year or so is going to be at least I think it'll be who knows where it'll come out. But, it's a long term, it's a great economy, right? And it's got a young population. They love going to the malls. So it's not something we'd rule out. Just like in Europe, I don't know when you went to Europe, but, we bought into a French shopping center company in 12, okay? And the only guys that I knew that were there were Carlos Slim and Blackstone. Okay?
You beat us there, David.
Okay, and
that one.
I got the stock position. I'm up $1.5 billion on it because I took the analysis that these real estate shopping centers cash flow are stickier than everybody thinks. Okay, and again, the headline is you have a mall that goes out of business. All malls are going out of business. It just doesn't work that way. And that's, by the way, that's the way they write at some great publications, or used to be great. I won't name names, but happy to after this. But I like Brazil, but I just still think it's a year away. And the one thing I've learned over the years, having done a lot of M&A stuff, is you never get hurt if you have staying power if you buy quality assets. And I think in Brazil, that understanding what's quality and what's not is very important. And but underwriting's gotten easier in our business because you kind of know, at least in the mall business, what malls are good and what are bad. So we shouldn't be making those kind of mistakes.
And I guess, Barry, you've got a number of varieties when it comes to the mall business and the international scene. I mean, what's so attractive to you about Brazil right now? Is it the value?
It's a combination of deep value for world-class companies and assets, and a currency that is even deeper value. I want to get to Brazil in a second. I just want to quickly say, David mentioned contrarian, and I just want to make a comment on the U.S. mall sector and opportunities in the U.S., which is that when we did our transaction with GGP, shockingly, it was contrarian at the time because people were negative on the sector, and fantastic for us. And we spun out a company from GGP, which was its B-mall portfolio that we named Rouse. And we learned a lot about B-malls. And B-malls, as David would know better than anybody, they can go dark and they could be a disaster. Or they can be the only mall in town in 60-mile radius that are generating sales that aren't A-mall quality, but still opportunities to generate steady cash flow, provide solutions to tenants, put more capital in to create more value. And Rouse was trading poorly, and we privatized it this year. It was a contrarian investment, you could say, but one based on very strong fundamental concepts in terms of the market misunderstanding the value of a great company that had great assets. Contrarian in Brazil, you could say that all the points that David or others would make about concerns. The fact is that, for us, Brazil is the model of what we would like to be in every country that we're in. We own agricultural land, we own timber, we own hydropower generation, transmission lines, highways.
All the stuff that people need as they climb the ladder.
Well, I would say land in the most raw form to the most developed form. And it gives us a window on all of the things that David said you need to know. And it gives us, great clarity into what's really happening in the underlying economy. And we understand the politics and we understand the legal system. And we know that there's a respect for capital there, which some legal systems might appear to be similar to ours, but something could change and the populace might not have a respect for capital. Brazil has a respect for capital. We can see through, and I should add home building and things like that, we can see that the numbers in Brazil are starting to be past where they have bottomed out. Maybe they'll bounce along at a bottom for a while, but things are about to change. And if you look at the office stock, for example, I think that the statistics are 20% are Class A, 40% are Class B, and the remaining 40% doesn't have air conditioning, and no international tenant would want to be in those buildings. Well, we can deliver to international tenants that know what it's like to be in a Brookfield building, a great solution in the best locations in Brazil, and this is a fantastic time for us to take advantage of that in a market where there's both value in the underlying asset and there's value in the currency. And we have a good sense of what's happening. We have, going back to the question of the US versus international, we think that the best opportunities now, given where we are in the cycle, are in developing countries. We've done transactions in China, in India, same kind of thing, where we were able to buy real estate, existing real estate, not development stories, where we're delivering solutions to global tenants that like to be in Brookfield-style buildings. But we still think that 50% of our opportunistic investments will be in the US, which is interesting, if you just think about it in terms of what's the opportunity in the US versus developing countries. The fact is that the US is such a major economy. There's situations like, Rouse and Associated Estates that I mentioned and others. It happens, and as a result, from an opportunistic perspective, we think it can work, and then it depends on what kind of capital you're trying to deploy. Like, we have opportunistic money, we have core plus type money, and there's a lot of that in the US too. So.
Does everybody agree with that the U.S. is arguably a better opportunity than some of these other areas? I want to get into China
Well,
for a minute.
just remember and put it in this perspective. So when people protest against Donald Trump, it's like 50 people, right? I don't know, 80, 100, whatever.
Yeah.
I mean, the media makes it out to be like, thousands, but it's probably 50,
you're right.
100 people. When they protested against Wilma, it was 2 million people. Okay, so to me,
Safety.
to me,
Actually, it's a great point.
that means, the cap rates should be okay because you do have a volatile place down there, and when we start having 2 million people here protest, right, which is not inconceivable. Maybe it's by design by some. That's when you get nervous. So, I think long-term Brazil is great, but don't forget about when people go to the streets like that. There's a lot of shit that's going to happen between now and then. Okay, and so see if it calms down. At least as a that's how I would simply look at it. Okay.
Would you expect disruption from the people if, in fact, Donald Trump were to win?
We just changed panels.
Yeah, exactly. The future of mankind.
Yeah, exactly.
I was wondering what that is, but I
We've
think
got
that's
10
the
minutes.
overall
Let's go.
conference. That's the overall conference. Let me ask you about China for a second. You don't have to answer that right now.
Before we talk about China, can I just I think to Barry's point, it really comes down to how you risk the investment. And to your comment about cap rate spread, that's how you evaluate those opportunities. And I think that it really comes back to who are your investors and what are they looking for?
And your cost of capital.
Right. So for my companies, that's probably the last thing that my investors want to hear, is that we're taking a bet on something that is some number of years out into the future. That's where a Brookfield plays a very important role in the real estate market, because they have that long money and they have different pockets for different. We stick to sector specific, but primarily all stable income producing. So if I were to bring somebody in as an investor under that premise, and then turn around and take capital that they've committed to me and put it in a longer play, they would probably scratch their heads and frankly be pretty upset that's not our role. That is the asset manager role that a Brookfield plays. So
Right.
we really have to.
But it's
kind of-
actually, I'd ask Barry this. Barry, if an A cap rate mall in Brazil, what would be the cap rate for an A mall in Brazil, do you think? 6, probably?
Higher.
I was going to say that's pretty low.
Yeah. In this market today, it would be higher. There's just not a lot of money coming into Brazil right now to buy malls. I mean, we own them. If you want.
But if you look at where, no. But I said A malls.
Oh, A.
I said 8.
I had to. It was there. It was there. It was there. I
That
had
was
to.
a lot.
Okay.
Logic.
It was there. I had
By
to.
the way,
No, you had
these
to.
malls, I don't know if anybody has been to Brazil, but these are some of the most spectacular shopping areas.
They actually
Really?
do. They build
are
great product.
spectacular.
They
There you
really
go.
do.
He said 8 cap now, if you want to buy
Yeah,
it.
but
No.
all right. So
and-
think it's I mean, the public companies trade. They don't. They trade at 8 or 9s, right?
Yeah.
And so let's say, and we could talk about NAV and whether that should be how real estate companies ought to be valued. I don't think we should be that. I think it limits us, but that's how the analytic community always wants us to look at, NAV and whatnot, as opposed to earnings growth, dividend growth, whatever. But think about it this way. So if people would put us at a 5 cap rate of value of our assets, and the A mall guys are operating at an 8 or 9.
Yeah.
Does that sound great to you? I don't think so, but I don't know. I mean, that's why somebody, if
They're an 8 for a reason.
yeah, but think, I mean, they were priced that way because they had unbelievable cash flow growth in the future. But is that enough? Has it dislocated enough? Because I would have thought, they'd be 10s and 11s.
Right, should it be a 12?
Right. Yeah,
Right.
exactly.
Yeah.
So
Well, that's what you said.
Yeah.
Nobody's really buying them.
No. I mean,
There's not a
and
lot of flow of traffic.
right. So I totally agree that for assignment properties, it makes no sense.
Right.
For investors that are trying to achieve opportunistic returns, it makes sense. It makes sense for them to do it. Sorry, the mall deal David is mentioning doesn't necessarily make sense, but it makes sense for pension funds that are trying to hit targeted returns with a certain part of their portfolio having a certain
well,
amount of risk.
again, I wouldn't say it doesn't make sense for us. I'm just waiting for the 10 and 11.
Right, no, fair enough.
Okay.
But I was just going to make the
Yeah,
point, that for those pension funds that are stewards of really important capital for people in this country and the rest of the world, they need to do it with not just managers generally who can do it, but they need to do it with managers. A little, prop for Brookfield. I mean, we put a quarter of the funds, the LP capital, into the funds that we raise comes from our own balance sheet. So it needs to be aligned with people that aren't just going to take a flyer on speculative markets, but do it in a way where there's a real focus on preservation of one's own capital, which is a big part of our approach.
So it feels like China has been a disruption for U.S. markets or really global markets, but there's also opportunity. You recently did a deal, right, with the Chinese.
Yeah.
Let's talk about that. And how important is China? Should we be focused on China as it relates to the U.S. real estate market?
Well, I think the flight of capital is again, allocated to the right markets. And when the Chinese are looking to get out of their markets to deploy capital safe and secure, this is the first place they've been looking, and it's been consistent. The interesting thing is just what you said. They're not looking for partners when other foreign capital sources are. They're coming in and trying to control an asset or a play, and as a result, we've seen this picture before, which is foreign capital coming to this country on a dislocated basis, thinking they can understand where the markets are and what the values are, and then eventually failing in some level from an operating standpoint or a future growth standpoint.
And that's what Japan did.
We've seen it on multiple occasions. So I think the dislocation there is just flight of capital. Now the capital is being much more challenged to get out of China to come to the United States on any large amount, and clearly, as Barry said, it is specific to institutional only. They tried to get individual family trusts and the likes of that money out, and it's been much more challenging.
And I also think that China in particular, their criteria, their investment criteria is very different than ours. Their criteria is move money out of China, put it in what they consider to be the safest of safe assets. So they are buying the trophies. They are paying the 2 and 3 caps that just make us all scratch our head. But when you take a minute to say, okay, to them that accomplished their goal, 2% return. If it's levered, unlevered, that doesn't really matter. But that money is safe. If something happens to the Chinese currency, that money's out of the country. And the Chinese economy has grown so quickly over the last 10 years, 20 years. So to me, those are outliers. Those are headlines.
And you're still seeing the same pace in terms of the amount of money coming in from China. That hasn't slowed.
I don't know if we're going to see it
No, I
in
think it's definitely
16, 17.
definitely slowed.
We saw it in 15. Foreign capital was somewhere in nearly 30% of the real estate transactions in 2015, and I think 7% of that came from China. So you can't ignore them. You can't say it's going to go away. I do think it'll slow. As Victor was saying, I agree. But they'll be here. You'll see Russian money.
Did that slow? I mean, Russian money?
Yes,
Residential in New York.
it's gone.
That's what I assumed.
The Chinese.
For sale.
Yeah, it is.
Yeah, flipped. Right.
The Chinese are tending to be the buyer of that
Of
now.
Russian assets.
Yeah. But again, same thing, move capital.
Just what I've observed is that the people that were trying to bring Russian money into the U.S. are now trying to bring the U.S. money into Russia and as middlemen in transactions because they think that the opportunities are great there. Not for us, but that's what I see.
And I guess then there's Middle Eastern money as well, still coming in. I mean, I'm just wondering if the flow of international money has slowed.
Well,
coming
again,
into the
from what we've seen in our fundraising, the Middle Eastern money has been reduced. It's been offset by Chinese. But these Middle Eastern investors, these are long-standing now pools of capital. They've diversified into lots of other holdings. Yeah. They are reinvesting. I mean, there's some amount that's being drawn in for their local needs, but there's still a lot of money, and I suspect that oil prices are going to move to a level where they're still going to have a lot of money.
The bid ask of Middle Eastern money has changed also, because 10 years ago it was a significant opportunity for a lot of U.S. companies to have that money. Today, that money, frankly, it's not necessarily that it's so expensive, but it comes with a lot of rules, and that's new.
And they all want the same assets. Okay, so that's if they are here, they all want the same assets, and those assets tend to be, New York office building. If you had to just cut through it, they're very nervous about the mall business.
Yep.
I mean, Barry, I guess you would know better. I mean, you're partners with all these guys, but it's complicated. The mall business is an operating business, and people come in and out, you do this, you do that, and, they tend to like, just, here's a building, I get it, I understand
Just
it.
want to be there.
So
So let me go down the line as we wrap up here. Can you name one item that you are watching the closest to get a feeling of whether or not we've seen a real change, a fundamental change in this market, whether it's the mall business or residential or commercial? What would you say is, I mean, obviously supply is one thing we've discussed, but what's the one item that you're watching most closely to see an indicator of whether or not this market has actually changed? Barry?
Well, I would say, generally for us, it's watching to see its interest rates, cash flow growth, I mean, really across the board, given who we are, and whether cash flow is going to keep up with interest rates.
Yeah, I think we look at it similarly, but I think I would also add, shadow space, sublease space. When you start seeing companies take oversupply internally, that's really, they're biting off more they can chew or they use, and then obviously the employment numbers are key.
I'm going to answer a little bit differently. I look at inflation, and real estate is probably one of the few asset classes that looks to inflation as a positive. And I'd like to see some inflation. I'd like to see that as a rent driver. It'll be a great indicator of a strong, sustainable economy in the U.S., and that'll have benefit for just about every real estate asset class out there.
You're seeing it?
Not yet, but when we see it, it'll be a
That'll be a
positive.
good confirmation for you, David.
I'd say simply demand. That's the most important thing in real estate is
Sure,
demand.
especially as it relates to retail.
Sure. And that's the thing I monitor is really, in my case, do retailers want, more stores?
Gentlemen,
Simple.
thank you very much.
Thank
Ladies
you.
and gentlemen, thank you, David Simon, Michael Weil, Victor Coleman, and Barry Blattman.
Thank you.